But Mayuresh Joshi, fund manager at Angel Broking, also is with us. Mayuresh, two quick numbers if you've had the chance to look at them and analyze. Z, which just came by, a bit of a mixed bag, and NIT Technologies as the numbers are still filtering in.
Afternoon, Aisha. Clearly, I think these numbers, at least in terms of how the top line has grown, has been quite good. In terms of how their ad revenues have panned out, is quite good as well. So I think they've shown a robust growth happening on that front. And clearly, over the next 2 years as well, I think my own take is that even if you assume subscription revenue is growing at a very tepid pace of 11 to 12%, ad revenues growing at 21, 22 odd percent, you're still looking at revenues for the next 2 years for around 4,100 crores. Coming through the ad business itself, and from the subscription business close to 2,500 odd crores. So that's a substantial increase in terms of top line that you're probably expected to witness. Margins expected to stay around the same levels. So in my opinion, it's a very, very stable performance. I think the disclaimer being that we might be holding this stock on behalf of our clients in our PMS schemes. Clearly, when it comes to NIT Technologies, I think the numbers more or less in line with estimates. And clearly, I think the management commentary is something that I would be keenly watching out for in terms of two things. A, discretionary spending trends going forward, and their key business verticals, how they have fared either quarter on quarter, year on year, and the trends thereof as well.
Do you think Z has a long way to go? Because not for the first quarter, but for the second or the third quarter now, they've reported optimism. Ad revenue, which is the most important benchmark for any media company, seems to be indicating that good days are coming for a broadcasting company like like Z.
Well, yes, good afternoon. And clearly, I think if you look at how the ad revenues have panned out for Z, if you exclude the ad TV part, which is a new channel where you've seen substantial growth happening in ads, and even the management commentaries thereof, was if you exclude ad TV, and if you look at the ad revenue growth expected going forward, there is still expectations for exponential ad revenue growth. So clearly, I think it's a mix of how these things move forward. Add to that, I think the sports business losses, I think the management was very, very clear that they'll curtail it below 100 odd crores. So I think even that is going to be a key telling point going forward in how the sports business pans out, and again how the new launches are possibly faring. So I think our take is that ad revenue growth should sustain, as I mentioned earlier, the subscription revenue. We've taken a very muted amount of estimates over the next 2 years. If those estimates beat our own take, I think the overall consolidated revenues will be much better. So yes, I think we maintain a very positive stance on Z with a long-term perspective.
Your view on the Nifty? I'm asking you the most obvious but perhaps the most difficult question.
Very volatile times, Nikunj, and very difficult to predict sitting here in Bombay of what is really happening in markets like China. And we are extremely data dependent. Whatever data comes out, I think we react to those numbers. So clearly volatility in data numbers is expected to come through. What really happens with crude over the next few months will be a telling point. Having said that, I think we've been harping on this point domestically of earnings not reviving. And clearly, I think Q3, Q4, we are not going to see any respite probably happening on the corporate earnings front. The capex cycle, again, the data that we will be probably analyzing doesn't seem to indicate that there is any recovery happening there as well in a very fast and a gradual manner. So I think that recovery again is going to be very, very slow and tepid over the next few quarters. So the markets have gestated these facts to a large extent. But clearly, I think what happens internationally in terms of how crude behaves, what data points probably come out from the Chinese market, what action the US Fed does, and individually, I think how stocks perform in terms of earnings, even though the earnings expected to be poor, are going to be the telling points. Add to that, I think what really happens with the budget. So clearly, we are here for volatile times. There might be further softness into the markets as far as the Nifty levels are concerned. But clearly, I think we still believe that the consolidation phase that we're probably going through is going to continue at least for a quarter.
ICICI Bank, the cheapest private bank, yet it is the worst performing private bank. Mayuresh?
Oh yes, again, and if you look at why is that happening, I think in terms of asset quality, I think there are concerns again being laid out. And will those concerns probably get played out on balance sheets? Probably yes, over the next 2 quarters. Once the cleaning up mechanism starts, the kind of exposure that a lot of these larger private banks have towards the corporate side, the SME side, you might have the cleaning act probably done in this quarter and the next. But in our opinion, again, I think once this is done over the next 2 quarters, you'll be probably looking at a much cleaner, leaner, and a meaner balance sheet for a lot of these larger private sector banks. Add to that, I think you're looking at their core strengths of a huge branch network, capital adequacy being strong, and those factors will probably aid their credit growth going forward. And credit costs, again, are a little bit higher this time around, but FY 17, I think once these things start normalizing, the credit cost should stabilize as well, which effectively means that the return ratios, both ROE and ROE, should probably expand. So clearly, the next 2 quarters is going to be extremely soft for the banking industry as a whole. ICICI Bank being no exception to that. You've already seen the stock price performance happening in anticipation of what might happen in this quarter and next. But clearly, if you've got a year and a half's time horizon looking forward from this quarter, my belief is that any declines, I think, become a very good buying opportunity for stocks like ICICI Bank.
Mayuresh, what is the big concern? Because one has seen really a synchronized fall and sort of throwing in the towel when it comes to the banking sector. What is the big concern? I mean, could we see a default-like situation with any of the banking pack? What is the street rumor that you're picking up?
I'm not too sure about rumors, Ayesha, but clearly I think if you talk about the end user industries that these banks have lent to, a lot of these industries, even with the RBI rate cuts, are still going through a lot of pain when it comes to their working capital constraints. So you're talking about real estate, metals, steel, gems and jewelry, you're probably talking about the sugar sector as well. You're still seeing painful points probably come through. You're not seeing any massive expansion probably happening on that front. The second point I would probably like to bring to your notice is the kind of GNPs that probably are still existing in the system. And again, I think if those are started or will start getting recognized over the period of time, as the RBI governor has indicated, to start cleaning up the balance sheets, you're probably looking at a much elevated number probably happening on that front, along with provisioning, which will probably increase as well, which will take a massive hit on the bottom lines. But it is seemed to be understood from the numbers probably in this quarter and the next, how banks are coming up with their act. And clearly, I think those 2 factors will be the guiding factors on how the banking index has performed. It has largely underperformed because of these 2 factors. If they start getting recognized again over the next 2 quarters, I think you're still going to see some amount of pain being left in the banking stocks.
Mayuresh, about a year ago, everybody was bullish on private banks and everyone was bullish on large cap pharma. Those are the 2 sectors which perhaps have taken the largest earnings downgrade. So banks we've discussed, but what about pharmaceutical? Because the US FDA problems are so real and they are so big, which is staring on your face, that they will not go away in a hurry. So what should one do with pharma companies? Because on a daily basis, one or the other pharma company is getting hit because of these US FDA problems.
Oh, again, Nikunj, I think clearly I can't preempt on what pharma company can get hit by FDA issues, but clearly I think for the sector as a whole, the historical valuations were a tad higher, and we've always maintained our stance to have a bottom-up approach or a very stock-specific approach when it comes to the pharma sector as a whole. Having said that, probably I think our belief is that we are still looking out for companies within the large and the mid-cap packs, where I think the earnings visibility might still be a little bit more sanguine going forward. So clearly, I think Sun Pharma, in our opinion, still presents a high risk-reward situation, where in our opinion, again, a lot of risks attached to that stock, both in terms of the network integration issues with Ranbaxy, the FDA issues that have already started playing out on that stock, the kind of letters that we probably got, the contents of the letter specifically related to Halol. Our own take is that the worst probably is over in terms of how earnings might pan out, specifically from an FY16 perspective. It is probably all in the price. And FY17, I should see earnings bump up happening. So I think we're very, very selective on the pharma story as a whole. Sun probably is one of the stocks that we're probably liking, the large cap pharma name. And clearly, I think valuations, as I mentioned earlier, compared to the historical valuations, a little bit too high generally for the sector, and a lot of companies probably as a component within the sector itself.
Okay, Mayuresh, good chatting with you. Thanks much really for analyzing not just the market but the individual earnings as well, which have filtered in. Where are we on the markets? Still status quo, 75.26, making its, attempts, but very feeble ones at that, to try and break into the green. That's the index for you. Very range bound in a very, very narrow band. Don't go by those jagged edges today. The small caps, they are the one which are the spot of bother. They're the underperforming lot within the whole market, down by about 1%, and this after starting off with sheer outperformance as opposed to the benchmark indices. Let's take a quick break then. When we come back, some more number crunching and talk about the markets.